Hello, everyone, and welcome back. This is chapter 7 of the Mastermind. Very important chapter coming right after chapter 6, where we talked about market profiles, right? We mentioned market profiles at the beginning of the Mastermind in the first few chapters, and I brought it back up last chapter. We dived more into it and we learned some more caveats to it. Now, in this chapter, we will learn how to use the market profiles within the market, within different ranges. So in the market, we know there are a few different ranges, one of them being a timed range, one of them being a dealing range, and the other one being an expansion range, an expansion leg, and so on. All right, so this is chapter 7. Let's get right into it. So what exactly is a dealing range? For those of you who are new to ICT, you probably have never heard this term. For those of you who know ICT and who have learned from him, you guys will be bored. Still, repetition is key. So what is it? A dealing range is the high and low that price points established during a trading session or a specific time frame. It defines the boundaries where price action fluctuates before potentially breaking out. So what does this paragraph actually mean? First off, a dealing range is the high and low. We have the high and low that price points established during a trading session or a specific time frame. During this specific time, during this specific session, price formed a high and low. This will tell you a range. It will create a range on your chart so that you can visualize price action within it. Right? Very important range. Price action will fluctuate within the range before either breaking out or below. For a true dealing range to exist, both sides of liquidity, highs and lows, must be taken. No exceptions. So this is not any random range to the right of your screen here. This high and low from this specific session took out buy-side liquidity above these highs into a PD array, and took out sell-side liquidity below these lows, potentially hitting a key level. Regardless of the key level, this is a dealing range. High and low, both high and low took out liquidity. Both sides of liquidity must be taken and formed a dealing range. Why does this range work? It reflects areas of liquidity where traders buy and sell. Reactions like reversals or breakouts often occur near these boundaries. This basically means that near the highs and lows, we will likely see reversals or breakouts. Near the highs and lows are where the new liquidity now rests. All right, so external liquidity rests above this high and external liquidity rests below this low. So here are some tips before moving forward. Wait for confirmation before acting on an actual breakout of the dealing range. Combine with other tools such as key levels and premium and discount. This basically means that in order to use a dealing range, you must know about key levels and the premium and discount of that dealing range. We will talk about the premium discount later on in this lecture. Key levels that form in a premium when bearish are key, and key levels that form in a discount when bullish are key. Here's another tip. Monitor the time spent within the range. All right, there's a specific amount of time, give or take a few minutes, that price should spend within a dealing range before either breaking out or breaking down. Study. Moving on, a deeper look. Why is it a dealing range? Why is it a dealing range and not a normal range? Because the market will want to deal with the midpoint of the range. All right? The market will want to deal price to the midpoint of the range. Why? Because we took out both sell side and buy side liquidity. The new liquidity rests around the midpoint of the range, which represents the fair value. Above the midpoint is a premium. You will be looking for key levels in a premium when you are bearish. And in the discount below the midpoint, you will be looking for key levels when bullish. So the midpoint interaction, the algorithm will reprice to the midpoint and specific key levels at specific key times. Right? So focusing on the midpoint now rather than the key levels, the algorithm controlling the markets will push prices towards the midpoint at specific times. What does this mean? This means that you can catch an expansion leg towards the midpoint at a specific time. This also means that at that specific time, we can be hitting a key level to see a reversal on the lower time frame. All right, so targets, from there, it seeks a premium price above the midpoint. So basically to the right here, you see 8:30 a.m., a key time in the market, tapping into a bearish order block above the midpoint. This is a bearish key level in a premium market above the midpoint. Price reacted to this key level at exactly 8:30 and started to reverse lower. So here's a view of a dealing range in the opposing direction. We have the buy side liquidity taken, sell side liquidity taken, creating this specific range right here. Now, if we are bullish, we will look for a key level below the midpoint. Price will reverse on the lower time frame and retrace on the higher time frame down to the key level below the midpoint in a discount market, like so, into a key level expanding higher. All right. More on the dealing range. So what exactly is it used for? We can use the dealing range as a filter to your trades. It is used to build the higher time frame narrative. It is used to look for targets, your take profits, and it is used to manage your risk. Now, what do I mean when I say the dealing range is used as a filter? This means that when you apply the dealing range, there must be specific things that you are looking for. These specific things must validate or invalidate your trade ideas. Every time you apply a filter, it must invalidate or validate an idea. That is the whole point of a trading filter. The dealing range being one of these filters. Now, if I apply the Fibonacci to this specific dealing range, why is this a dealing range? We took out buy side liquidity above these highs, and we took out sell side liquidity below these lows. This forms the dealing range high and low. Using a Fibonacci, we can recognize the midpoint of this dealing range. Our filter in this scenario would be if we are bearish, we need price to retrace into a premium, hitting a key level, and then we look for our entry model. That is the filter. Now, price rests below the midpoint. What does this tell you? No trade. That is the filter and validation of your trade idea. Now, if price was inside of a premium, tapping a key level, forming a CRT, forming your entry model on the lower time frame in alignment with market profiles, then what does that say? That means your filter is telling you your trade idea is validated. Okay, now how can we use the dealing range for the higher time frame narrative? How can we use a dealing range for higher time frame bias? First off, if price is in a premium market, actually, let's start before that. Price is below the midpoint right here. We can expect a reversal on the lower time frame and a retracement on the higher time frame to at least the midpoint of the range. So this means that the higher time frame is bullish to where at least the midpoint of this range. Then we reassess price, we reanalyze price, and see if price wants to further target a key level in this premium market, or if it wants to break out of this midpoint level and head towards the opposing end. Regardless, you are playing the expansion leg on the lower time frame towards the midpoint of the range. Now, if price was above the midpoint and you are bearish, and you have a bearish key level above in a premium, this tells you from a higher time frame perspective that the market will likely turn around at that instant, at that moment. All right, so that's how you use the dealing range to build a higher time frame narrative. You can use it to look for targets. Okay, what does this mean? This means if you are entering long in this scenario right here, as you can see, a bullish CRT below a low key level, CRT formation, entry on the lower time frame, your higher time frame DOL, draw on liquidity, would be this midpoint of the dealing range. That is the target. So this is how the dealing range can help you form your targets. And of course, at the end of the day, putting all these together, it is used to manage your risk. This means you know once price breaks out above the range, if you were short, if you were bearish, and price breaks out above this high, you now know your trade thesis was invalidated, and to get stopped out immediately, you manage the risk accordingly. You know, to manage your risk, you must only enter short in a premium and only enter long in a discount. Managing your risk. So many different ways to do so. Those are just a few examples. Now, when we are bullish, we look for key levels in a discount market. When we are bearish, we look for key levels in a premium market. We use the higher time frames to form the dealing range and the lower time frames to profile the market. We talked about market profiling in the last chapter and in the first few chapters of this mastermind. What does this mean? If we have a key level in a premium, price retraces into the premium, does not hit the key level, but starts to range on the lower time frame. We now have a bearish dealing range. We are bearish on the higher time frame. Price is in a premium. So now we know we are allowed to enter our shorts. Why? Because price is in the premium. That is the first filter. Next, we locate the key level, second filter. Key level and dealing range come from the higher time frame. Now we drop down time frames to the lower time frame. Let's say this is a daily, you would drop down to an hourly. Look to profile the market. Either an hourly or 15-minute is allowed. So the lower time frame to profile, if we are ranging right below the daily key level, which can be this order block right here, daily key level, ranging below it, we would manipulate into the key level and then reverse down, expand downwards. So that's how you would profile on the lower time frame and use the higher time frame to create the dealing range. So, taking a look at the same example that we looked at right here on the right side of our screen, price is rejecting these lows, right? So sell side liquidity is taken, buy side liquidity is taken. high time frame dealing range is formed. Now let's try to locate some key levels. I can see one right here, fair value gap, and I can see one right here, a bearish order block. This is the daily time frame on NQ. So the daily in this scenario is going to be used as our higher time frame to form what? To form the dealing range. Our higher time frame is also used to form the key levels, to look for the key levels. This is a key level, this bearish PD array right here, fair value gap, and this is a bearish key level right here, a daily order block to go short. Why is this an order block? Why is this not the order block? Why is this not the order block? Why is this the order block? Because price filled liquidity with this thick up close green candle. What liquidity did we fill? This fair value gap to the left. Formed new liquidity within this range. Broke below it, closed below it. Price immediately rejected off of the order block and came to expand lower towards where? The draw on liquidity, which was this low right here, which we are now respecting and rejecting through this bullish CRT. Okay, so that's how you can find the key levels, and that's how you find the dealing range. As you can see, we have the bearish fair value gap right here. We also have, so the bearish fair value gap is a key level on the daily time frame, right here, daily. And we also have a bearish order block on the daily time frame, which is a key level. Now, we know that, well, actually, if you guys have been paying attention, you would know that within a higher time frame fair value gap, there will always be a lower time frame turtle soup. This is an entry model in itself. What does this mean? This means that if you are in a premium market and price is bearish, you are bearish in a premium, you want to be entering short, you find a key level, and that key level is in the form of a fair value gap on the higher time frame, which is a daily. You then look for price to tap into that fair value gap, look for a 4-hour high. Why a 4-hour? Because you are on the daily. If this was a 4-hour order block, 4-hour fair value gap, you would go on to a 15-minute or 1 hour to look for the highs to be turtle souped, and then target a short opportunity at that high within the fair value gap. So let's take a look at an example of this. As you can see, price is retracing up. We hit the midpoint of the range here, right? So if you were going long, the first draw on liquidity would be the midpoint. We then got a retracement OTE style entry to go long. Why did we not stop here? Why are we continuing to push higher? Because there is a key level above the midpoint. Okay. This is the lower time frame here, the 4-hour time frame. You can see price is consolidating below a bearish key level. What bearish key level? This 1-day daily order block over here and the daily fair value gap. We are consolidating below it. We know through market profiles, when we range below a key level, we will manipulate above the key level and then reverse and expand lower. Right? Where are we going to expand? To the opposing end of the range. Okay. So right here is the range. Dropping down to a 1-hour time frame to zoom into this range, you can see a lot more clear. A range formation below a key level. What do we anticipate in this specific range? We anticipate a range, key level above a range. That means manipulation is likely to occur next. We will tap into the key level, come back down, tap above that high, turtle soup inside of the key level, and then come lower. So as you can see, what I mentioned before was this daily fair value gap. As we know, an entry model is a higher time frame fair value gap and a lower time frame turtle soup. Guys, pay attention. Whoever came here to learn about turtle soups, I am teaching an entry model right here. Okay? Your entry, when everything is aligned perfectly, meaning what? Your filters are aligned. You have the dealing range, you have the bias, you have the narrative, you have the market profiles aligning. Then you can use the higher time frame fair value gap with the lower time frame turtle soup. In this scenario, it would be this 4-hour high, and you can enter short as soon as price touches this 4-hour high with a 1 to 3 R to R trade. Or you can enter this trade with a stop loss at the high of the fair value gap and your take profits to the draw on liquidity, which would then be an expansion on the higher time frame down to this draw on liquidity, the low of the dealing range. All right, so potential lower time frame turtle soup within a higher time frame fair value gap right here. And if you guys are confused with what I just said, I spoke fairly quickly. But if you are confused, rewind, rewatch what I said. I just gave away some gems that I was going to release, but I don't know if I was supposed to go that in depth on. Sometimes I get off track. Anyways, we expect this high to be turtle souped. What happens here? We are ranging below the key level. We will hit into the key level, come back down. Why are we coming back down? Because the real entry comes with the lower time frame turtle soup within the higher time frame key level. Turtle souping the high within the key level and then expanding lower. Let's take a look at what happens. That is exactly what occurs. Price ranges below the key level, manipulates into this high right here, and starts to expand lower. On the lower time frame, the 1-hour time frame, you can see a lot clearer. We have a range expansion, range manipulation into the key level, reversal, retracement, expansion, retracement, expansion, and so on. Where are we expanding off of? This 1-hour order block. Now, what comes to mind when you see this? Well, in my mind, if I was in your position, I would be thinking, where can I enter this trade if I was not entering a higher time frame turtle soup, such as a 1-hour time frame or a 4-hour chart? Well, you would then look for your CRT, and this is where everything combines together. So pay attention here. This is where everything aligns. This is where CRT and market profiling and dealing ranges and premium discount key levels, all of this stuff comes together. Right here, you would look for a CRT. Align the higher time frame with a lower time frame entry. Look for a lower time frame CRT such as the 9 a.m. CR model, 60-minute, 1-hour CRT. Where? At the turtle soup. This is the 8 a.m. candle. What a coincidence, am I right? Why would I create a 9 a.m. CR model? Because it is the most accurate model that I have ever seen to date. Prove me wrong, show me another model that beats the 9 a.m. CR, and I will gladly reveal everything else that I know. However, for now, the best model that I will ever release will be the 9 a.m. CR model. It is my personal model. I designed it myself, and you will never find another model as powerful as that one. Now, back to the lecture, enough ranting. 8 a.m. you draw the high and low, right? Basics of the 9 a.m. CR. High and low respected. The high was swept. Look at that. We are bearish. We are looking for the high to be swept. Look for your entry on the lower time frame to go short. Enter short to the opposing end of the CRL. And of course, if you are looking at the higher time frame, you could have entered short here and targeted the opposing end of this entire dealing range. You would enter up here, stop loss right above, and target the opposing end. That is how you will achieve monstrous R to R trades. Now, we will start to add the profiles. I mentioned them very briefly in the previous slides. Now we will take a deeper look. Let me just take a sip of water. So, in the case of a bullish directional order flow, when the bias is bullish, when the narrative is bullish, we form a dealing range, the low and the high. Why is this a dealing range? We took out buy-side liquidity and we took out sell-side liquidity. We took out a high and we took out a low. Formed a dealing range. This is the midpoint. We have a key level. And we will see what happens next. So we have two options in the case of a bullish directional order flow. When the bias is bullish, we only have two options available to us when the dealing range forms. Why would this be bullish? If this is a breakout on the higher time frame, meaning we turtle soup the low, we broke out above this high, closed above, we would be bullish. The first scenario would be a higher time frame retracement into a premium key level plus a lower time frame expansion. This equals a lower time frame retracement. So the lower time frame retracement is this purple line right here, and the lower time frame expansion or the higher time frame retracement is this black line right here. So price will retrace on the higher time frame. A retracement on the higher time frame is an expansion on the lower time frame into a premium key level. If there is a key level in a premium and price expands to it on the lower time frame, retracing to it on the higher time frame, we will then expect to see a lower time frame retracement. Right after this lower time frame retracement, we will expect to see an expansion below the midpoint. Okay, so what happens next, right? What happens after this retracement, after the lower time frame expansion into a bullish key level above the midpoint? After the lower time frame retracement, which is this right here, this purple line, you will anticipate a lower time frame expansion into a higher time frame discount market of the higher time frame dealing range. That means you will expect to see expansion into a discount market anything below this midpoint of what the higher time frame dealing range. What will happen next? So what is the point of this happening? When price reaches into the discount market and hits a key level, you will anticipate a reversal. Okay, so we have a key level in a premium market, but we are bullish. We will not enter longs over here. Why? Because this will be a lower time frame retracement, fooling everybody to enter long. Then price will expand lower into a discounted key level, a key level below the midpoint of the dealing range. At that specific key level, you will expect to see an expansion upwards. Okay? A reversal on the lower time frame. Why is this a reversal on the lower time frame? Because we expanded into a key level. After expansion into a key level, you will anticipate a reversal. On the higher time frame, this is going to be seen as an expansion. Why? Because this entire move on the higher time frame is the retracement. What follows a retracement is an expansion. So this is an expansion on the higher time frame. What is the target? The higher time frame dealing range high. Okay? Very straightforward. Option number 2. So the first option, you saw price hit a key level in a premium, then retraced back up, expanding lower into a discount, and then hit another key level in a discount, and then expanded higher, reversal on the lower time frame, expansion on the higher time frame. The second option, and the more favorable option, is a higher time frame retracement directly into a key level, a discounted key level, meaning a key level in a discount market below the midpoint of the dealing range, plus a lower time frame expansion equals a lower time frame reversal, which means it is a higher time frame expansion towards the DOL. What is the drawn liquidity? The high of the higher time frame dealing range. So instead of price retracing to a key level in the premium, price instead expands on the lower time frame towards a key level in a discount. After an expansion comes what? A reversal. Reversal off of the key level, turtle soup, entry long, expansion coming next on the higher time frame, reversal coming from the lower time frame. Okay, very straightforward. Now, let's talk about the bearish directional order flow. So what happens when the situation is bearish, when the bias is bearish? We have two options, once again, very similar to the previous options of the bullish situations. Option 1, we have a key level in a discount and a lower time frame expansion. This will equal a lower time frame retracement. So we have a key level in a discount market, price is bearish. We have the key level in a discount. On the lower time frame, we will see a retracement towards that key level. Sorry, not a retracement, an expansion towards that key level. Then we will see a retracement coming back down. After the retracement, what will follow suit? An expansion. Where are we going to expand? Why did price not expand to the opposing end of this range when this key level was hit? Why is price reversing over here and heading above the midpoint? Why? Because we did not hit the fair value of the dealing range and neither the premium. Price will need to fetch a premium in order to continue heading lower. Not all the time, but in high probability scenarios. And we will only be focusing on the higher probability scenarios. Why? Because we want to filter out lower probability situations. All right. So we have a lower time frame expansion into the key level, a retracement on the lower time frame. And then we will likely see the expansion upwards. Where are we going to expand? After the lower time frame retracement, you will anticipate a lower time frame expansion into a premium key level. Keep in mind, price is still bearish. After we expand into a premium key level, what will come next? A reversal on the lower time frame and an expansion on the higher time frame. Where is this expansion on the higher time frame going to go? The expansion is going to push prices towards the opposing end of the dealing range low. All right. On the lower time frame, of course, this is going to be seen as a reversal. So this red line represents a reversal on the lower time frame and a higher time frame expansion. As you can see, price retraced to a discounted key level, coming back down, expanding into a premium market, hitting a premium key level, expansion on the lower time frame, reversal on the lower time frame, expansion on the higher time frame. This entire move upwards, this thing is seen, this price action right here is seen as a higher time frame retracement. Within a higher time frame retracement, we have lower time frame market profiles. That is a tip for you right there. Write that down. Study everything that we just explained right now and apply it to exactly what I just said. Within a higher time frame retracement, we have lower time frame market profiles. Now that statement is universal. Within a higher time frame expansion, we have lower time frame market profiles. within a higher time frame reversal, we have lower time frame market profiles, etc., etc. Okay? Moving on, option number 2, very similar to the bullish scenario. So in a bearish scenario, instead of having a key level and a discount like we saw in the previous example, we have a bearish key level in a premium market. So we have the lower time frame expansion into the premium key level. After the expansion into the premium key level, we will see a reversal on the lower time frame and an expansion on the higher time frame. Where's the expansion heading to? The opposing end of the dealing range. Okay? Some more tips about the dealing range. So the dealing range and key levels must be chosen on the higher time frame. I already mentioned this. This is how you create your bias and narrative. The market profiles come from the lower time frame. Okay? Now, with that being said, use what I just mentioned before. A higher time frame retracement has lower time frame market profiles. Okay? Next, only trade the lower time frame retracement and reversal after a lower time frame change in state of delivery. This means that you will only trade this reversal on the lower time frame if you see the lower time frame change in state of delivery. Avoid trading the counter expansion followed by retracements. What is this? What is the counter expansion followed by a retracement? Let me show you a perfect example. The counter expansion followed by the retracement is this expansion right here. So we have a lower time frame retracement after what? So this is a bullish scenario. After price hits a premium key level, price retraces on the lower time frame and then expands into the premium key level. Avoid trading this setup right here. You will likely get stopped out a bunch of times, not knowing when price is going to reverse back down. You are better off waiting for the the discounted key level right here to be hit, and then focusing on trading a reversal on the lower time frame after seeing a clear expansion into the key level, seeing the change in state of delivery, and entering long. Okay, that is what this statement right here means. Next, only trade the expansions towards the draw on liquidity for an insanely higher win rate. What does this mean? This means if you only focus on taking this trade, this trade, this trade, and this trade right here, meaning the expansion towards the draw on liquidity, the expansion that will cause the breakout, the expansion causing the breakout, the expansion towards the draw on liquidity. If you only focus on trading those, you will have a much higher win rate. They are much easier to spot. Why? Because you will need to wait for the proper filters. What filter? A premium key level in the case of a bearish scenario, and a discounted key level in the case of a premium, of a bullish scenario. Okay? Now that concludes the chapter. 38 minutes. I was speaking a lot faster. I want to make these videos shorter, but more packed with knowledge, more packed with information. This is not to be taken lightly. Study everything that you've learned so far. Come prepared for the next chapter and apply everything that you've learned in the previous chapters with this. Keep in mind that everything you learn can be put together. It is like a puzzle. The more pieces you have, the more complete the puzzle gets. What does that mean? That means the more puzzle pieces you have, the more information you get about CRT, about the markets, about the charts, the easier time you will have to analyze the charts, the easier it will be for you. All right. Thank you for attending this lecture. Thank you for attending chapter 7. Please be prepared for chapter 8 next week. And the backtesting session will be uploaded tomorrow, not today. Also, I want to mention that the private group is reopening to the public. You guys, of course, will get the discounted code. And that is it. With that being said, have a nice one and good evening to you.